Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Calavo Growers, Inc. annual report. Calavo Growers, Inc. market capitalization of 0 billion is materially smaller than most of its industry peers of roughly 2 billion. Calavo Growers, Inc. trades at a higher price-to-earnings ratio of 30 times and a higher price-to-book ratio of 1.95 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. The company maintains a moderate leverage profile, with liabilities making up 33% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes, such as buybacks or dividends, rather than operational deterioration. The share count has increased, while revenue and shareholder equity are declining. This indicates that management has not yet proven the business model is sustainable. This makes the investment case highly unfavorable. The company have a dividend yield of 3.54%. The income statement shows that the company revenue have been declining annually even though operating income have been improving. Although the drop in revenue is concerning, we can tell that management have been able to reduce cost. Calavo Growers, Inc. offers a diverse range of businesses and services that cater to various markets worldwide. The company's primary focus lies in the sourcing, packing, and distribution of fresh produce, including avocados, tomatoes, and papayas. This encompasses providing these products under its own brand, Calavo, as well as other trademarks such as Avo Fresco, Bueno, and El Dorado. In addition to fresh produce, Calavo Growers also engages in the processing of guacamole and other avocado-based products for retail grocers, club stores, food service operators, and wholesalers. This indicates a significant presence in the prepared foods market, where the company offers its products under various brand names, including Celebrate the Taste and the First Name in Avocados. The company operates through two main segments, fresh and prepared. The fresh segment likely focuses on the sourcing, packing, and distribution of fresh produce, while the prepared segment is dedicated to processing guacamole and other avocado-based products. Overall, Calavo Growers' business model encompasses a broad range of services that cater to various markets and customer needs. The stock price of Calavo Growers, Inc. has remained relatively stable over the past year, with no significant changes. Despite several major news events occurring within this timeframe, it is challenging to pinpoint the exact cause of this stability. One notable event was the announcement of a definitive agreement for Mission Produce, Inc., to acquire Calavo Growers in a cash and stock transaction valued at $27 per share on January 14, 2026. This type of acquisition news typically causes a significant change in stock price, but it is unclear if this event had any impact. Other events that may have contributed to the stability include the release of quarterly financial results for Q3 and Q4 fiscal year 2025, as well as the announcement of a $25 million stock repurchase program. However, without specific daily historical stock data for each announcement date, it is impossible to determine if these events resulted in a stock price movement strictly below a 3.59% threshold. The lack of significant change in Calavo Growers, Inc.'s stock price over the past year may be attributed to various factors, including the overall stability of the company's financial performance and the market's reaction to the acquisition news. It is also possible that the market has already priced in these events, resulting in a stable stock price. Further analysis would be required to determine the exact cause of this stability. The primary drivers of revenue growth or decline in the avocado industry can be categorized into several key areas. Revenue growth is primarily driven by favorable consumption trends, particularly among health-conscious consumers who are increasingly seeking out avocados as a nutritious and versatile ingredient. The growing Hispanic population in the U.S. also presents opportunities for increased demand. Additionally, year-round availability of imported fresh avocados has contributed to revenue growth, as well as higher market values for avocados. On the other hand, revenue decline is often driven by factors such as decreased demand due to health or food safety concerns, increased commodity costs, and fluctuations in fresh produce supply and cost. The loss of large customers can also have a significant impact on revenue. Furthermore, changes in customer strategies or purchasing patterns, financial difficulties faced by customers, and price increases implemented by the company can all contribute to revenue decline. In some cases, factors such as seasonality, availability of raw materials, and fluctuations in market prices can be considered neutral drivers that do not significantly impact revenue growth or decline. However, these factors can still have a significant impact on business operations and profitability. The net income of the company underwent significant changes between fiscal years 2024 and 2025. Initially, it decreased by $9.3 million in 2024 due to a goodwill impairment charge. However, this was followed by an increase of $20 million in 2025 compared to previous years. The net income attributable to non-controlling interest also saw a substantial rise of 233% from 2024 to 2025. The profit margins of the company experienced fluctuations as well. In terms of gross profit percentages, the fresh segment witnessed a decline from 10% to 8%, while the prepared segment showed an increase from 18% to 24%. The consolidated gross profit percentage remained unchanged at 10%. On the other hand, the operating income percentage decreased from 2.5% in 2024 to 3% in 2025. The effective tax rate of the company also underwent a change, decreasing from 25% in 2024 and 55% in 2023 to 19% in 2025. This reduction in the effective tax rate contributed positively to the net income of the company. Overall, while there were fluctuations in various aspects of the company's financial performance, the net income saw a significant increase in 2025 compared to previous years. The company's financial performance indicates a consistent trend of generating positive operating cash flow. According to the provided data, in fiscal 2025, the company reported an operating cash flow of $21.5 million, which is a clear indication of its ability to generate sufficient funds from its core operations. This positive trend continues into 2025, where the company's operating cash flow stands at $21,542. The fact that the company has been able to maintain a positive operating cash flow in both fiscal 2025 and 2025 suggests that it is well positioned to meet its financial obligations and invest in growth initiatives. Overall, these figures demonstrate the company's ability to generate sufficient funds from its core operations, which is a key indicator of its financial health. The performance of various segments and regions within the company has been mixed, with some areas excelling while others struggled. On a positive note, the avocado segment saw significant growth, with a 13% increase in net sales for fresh products and a 12% increase for prepared products. The fresh cut business also performed well, generating $83 million in revenue. In contrast, the tomato segment experienced a decline in sales, with a 35% decrease in fresh product sales and a 4% decrease in prepared product sales. This poor performance was attributed to weaker demand in certain regions, particularly the Northeast and Midwest U.S. markets. Regionally, the United States stood out as a strong performer, accounting for the majority of sales, 92%, 94%, and 94% of total sales across 3 years. However, Canada's performance was disappointing, with a significant drop to 6% of total sales in 2025 compared to 3% in 2024. Management is optimistic about the company's outlook, citing several key factors that will drive growth and success. The company believes its investments in packing house equipment, distribution centers, and skilled personnel will enable it to efficiently manage larger avocado crops, giving it a competitive advantage. A diverse sourcing network and long-standing grower relationships also provide a strong foundation for the business. This allows the company to maintain a reliable supply of high-quality avocados at competitive costs, supporting year-round availability and reducing reliance on any single region. Favorable consumption trends for avocado products persist due to broader consumer shifts toward health and wellness. Per capita avocado consumption in the U.S. has increased by 64% over the past decade, driven by sustained consumer demand. The company is also investing in promotional and advertising programs, which will have a positive long-term impact on average selling prices. Looking ahead, management expects avocado sales volume to increase in fiscal 2026 due to new customer recruitment and expanded global sourcing. The company is focused on expanding sales to existing customers and winning new customers across retail and food service channels. In terms of financials, the company believes that cash flows from operations, borrowings available under its credit facility, and other sources will be sufficient to satisfy future capital expenditures, working capital, and other financing requirements for at least the next 12 months. Overall, management is confident in the company's ability to navigate challenges and achieve long-term success. The company has made significant moves through acquisitions and divestitures to shape its business landscape. In terms of acquisitions, a notable merger agreement was signed with Mission Produce, Inc. in January 2026. This marked the beginning of a partnership that would likely have far-reaching implications for the company's operations. Another acquisition worth mentioning is the merger with Mission Produce, Inc., which also took place in January 2026. While details about this transaction are scarce, it is clear that the company was looking to expand its reach and capabilities through strategic partnerships. On the other hand, the company has also been involved in divestitures, where it has sold off certain business units to focus on core operations. One such example is the sale of the fresh cut business, formerly known as Renaissance Food Group, which was completed in August 2024. This move marked a significant shift in the company's strategy, allowing it to concentrate resources on more critical areas. The divestiture of the fresh cut business also highlights the company's willingness to adapt and evolve its business model in response to changing market conditions. By selling off non-core assets, the company can free up resources for more strategic investments and initiatives that align with its long-term goals. The company's financial activities have been transparent in their annual reports. One notable aspect is the payment of dividends to its shareholders. This indicates a commitment to rewarding investors for their loyalty and trust in the company. In addition to dividend payments, the company has also engaged in share buybacks. This strategic move aims to boost shareholder value by reducing the number of outstanding shares on the market. By doing so, the company can increase earnings per share and potentially drive up its stock price. Concerns about inventory buildup and supply chain disruptions are prevalent in the industry. One of the primary concerns is the potential for inventory buildup due to increased crop volumes and lower handling costs. This can lead to a surplus of products if not managed properly, resulting in significant financial losses. The issue of inventory buildup is further exacerbated by factors such as increased costs for purchased fruit, failure to optimize supply chains, and consolidation of production capacity in single manufacturing plants. For instance, the FDA detention hold on page 29 resulted in $5.1 million of incremental costs, including inventory write-downs on fruit diverted or sold at distressed prices. The avocado industry is particularly vulnerable to supply chain disruptions due to its reliance on imported produce from multiple sourcing regions. This creates pricing pressure that can reduce gross profit per carton, as seen on page 36. Additionally, the increase in organized crime in Mexico, affecting avocado farming, packing, and shipment activities, page 19, poses a significant risk to the industry. Supply chain disruptions are also attributed to geopolitical conflicts and related economic conditions, page 20. Furthermore, regulatory actions affecting imported produce and seasonal fluctuations in avocado prices or crop yields can materially affect quarterly results, pages 2-3. Overall, these concerns highlight the need for effective management of inventory buildup and supply chain resilience. That concludes the financial summary for Calavo Growers, Inc. Feel free to comment below, and I will be happy to answer them when possible.